Hi everyone, welcome to the second quarter installment of the quarterly UMPIP webinar series, Saving for Your Future Self. My name is Bob Christoffel. I serve as your Manager of Benefits Education here at Wespath, and alongside me is
Cheryl Hatcher, Senior Benefit Plan Specialist and Benefit Educator. Glad to be with you, Bob.
Great to be here, Cheryl, coming to you live from our Spellmeyer studio in Glenview, Illinois. We have a lot of information to share with you. Just a couple of housekeeping items before we get started. This webinar, as always in the series, is being recorded. You will be provided via an email with the recording link. There are some attachments in the toolbar of the GoToWebinar platform. We encourage you to ask questions throughout the broadcast. We have Frank O'Brien, Senior Benefits Educator, and Todd Creviston working behind the scenes answering your questions. Please use the question box. Wespath Benefits Investments, as you might know, is a general agency of the United Methodist Church. We live into our mission every day of caring for those who serve by providing investment and benefit services, not just retirement plans, but health, wellness, death, and disability plans that honor the mission and principles of the United Methodist Church. We manage money. That's the investment part of Wespath. Approximately $25 billion in assets, well over 100,000 participants, and that's an important number. That covers active clergy, retired clergy, lay participants, and surviving spouse. All this makes us the largest faith-based reporting plan in the world. Let's take a step back from the United Methodist Personal Investment Plan and really discuss where will retirement income come from. Usually, in most cases, generally, it doesn't come from one place. Nothing is designed to replace your whole paycheck. But when you add up possible different components, like Social Security, a source of monthly retirement income, if you're fortunate enough to have any personal savings, investments, bank accounts, that can help provide retirement income. If you are a clergy person, the mandatory plan for eligible clergy is the Clergy Retirement Security Plan, and that's both a defined benefit and a defined contribution plan. And Cheryl will share with you this afternoon some changes coming down the road with CRSP. If you've been in ministry a long time, you might also have access to your MPP, your Ministerial Pension Plan account. And there are some important changes we'll review that just came out of General Conference, but they're effective regarding MPP. You can annuitize 65% of your balance, becomes a lifetime source of income, or now you can fund that 65% into life stage retirement income. That 35% still remains an account balance. New plan we'll talk about today, Compass. Many of you will get retirement income from Compass down the road. That will not be effective until January 1st, 2026. And the focus today is going to be how the United Methodist Personal Investment Plan, or UMPIP, as many participants call it, can be a very important source of retirement income at a future date. It's a voluntary plan, so you have to make decisions about UMPIP. Looking at your Social Security retirement benefit, it is important that you set up an account at ssa.gov. Okay, it's easy and secure and really a recommended thing that you do. You can apply for benefits through the website later on. The way Social Security is designed, there is a social component to it, and it was never designed to replace your entire paycheck, but it does replace a higher percentage of a low-income person, a low-income worker's paycheck, and then a smaller percentage of a high-income worker's paycheck. So we're going to do just a brief trivia question. What percentage of income does Social Security place at full retirement age, we'll talk about that, for someone with an annual salary of about $54,000? So I'll give you a moment. And if you want to type the answer into the question box, Frank and Todd will monitor that. Does it replace 29% of someone's annual salary, 41%, 53%, or about 2/3, 65% of that person's annual salary? So I'll give you a moment to reflect on that. And we see all different answers coming in to the question box. I think I've seen every selection come in, and the answer is it replaces about 41% of that person's income. Last year, Social Security had a maximum benefit of $3,822. But in order to achieve or attain that maximum benefit, you would have had to have maximum earnings every year for 35 years. The average benefit on a monthly basis paid in 2024 is about $1,900, so replacing part of your paycheck. The most important decision you'll have to make about Social Security is, when do I take the benefit? Age has an impact on your benefits. You can delay your benefits or you can take them early. It used to be years ago, everybody had a 65-year-old, that was your full retirement age for Social Security. You can claim your benefits as early as age 62. You will receive a reduction in your benefit, and sometimes a significant reduction. Your FRA is tied to the year that you were born. If you're born in 1960 or after, your FRA, when you get your full monthly benefit, is age 67. If you decide to wait, maybe you don't need the income right away. Maybe indeed you're still working past your FRA, you'll get a higher benefit due to receiving these delayed retirement credits. You want to apply for Social Security benefits no later than age 70 because the delayed retirement credits will cease to accrue. On the opposite end, if you decide to go out under early retirement, you receive a reduction in your benefit. And the way that it's calculated, if you're 3 years or less early before your FRA, they reduce you 0.5% per month, 6 2/3% per year. And then if you're more than 3 years before your full retirement age, for example, you're age 62 and your FRA full retirement age is 67, for those additional years, the reduction is 0.5% per month or 5% per year. So if you get it at 62, you could see a significant reduction. But a lot of financial planners have been telling Social Security workers that if you delay receiving your benefits, every month that goes by, you get 0.2% increase in your benefit. So that's 8% per year. Those go away at age 70. So for example, if your FRA is 67 and you wait to 70, you can receive a 24% increase in your benefit. As a matter of fact, life stage retirement income has an optional component where if you let Wespath know you're going to delay receiving your Social Security benefit, we build a bridge and give you more of your account balances earlier on, and then make an adjustment when you reach that milestone age of 70. Now, let's get into the United Methodist Personal Investment Plan and how this plan, this voluntary plan, can become a really important source of retirement income later. It is technically considered a 403B, defined contribution plan. You do have an account balance. You do get quarterly statements online on your benefit access account. And it does accept both participant, that's employee, and employer contributions. Okay, you can direct the investments. You can self-manage your account. Cheryl's going to talk about different ways to invest later on. It gives you options, choice, and flexibility. You know, the general advantages of these plans, there are a lot of them, okay? Right off the bat, you're going to save money on taxes. You can choose to reduce your taxable income, or you can avoid taxes later with Roth contributions. We'll talk about those two different ways to contribute. We want to provide you with meaningful services like life stage investment management from managing investments, and then later on, when you retired, life stage retirement income. Now, you need to check with your employer. Okay, we have thousands of UMPIP plan sponsors. You might be eligible for employer contributions. Okay, we promote environmental stewardship, human rights, and sound corporate governance. And what we're trying to do for you as a participant in this plan is create long-term value and growth in your balances. We also provide you, if you're eligible, with EY financial planning services. And we'll talk a lot this afternoon about EY. So check with your employer if you're not enrolled already. Are there any minimum age requirements or months of service requirements or minimum hours that need to be worked each year? Each employer is different, so check with your employer if you're interested in enrolling. If your employer provides a contribution, that's, I think, a bonus on top of everything else. You know, just the tax advantages is so important. There might be a matching contribution, and that's tied directly to you having made a contribution. There's different matching formulas. You could have a non-matching formula, which really is just a fixed percentage of your compensation. No action is required on your part, and that goes into your account. There could be a conditional employer contribution as well as a discretionary, at the discretion of your employer, type of contributions. So again, check with your human resources or payroll person. Now, employer contributions, there's a term that's important to be familiar with. It's called vesting. Okay? And vesting really just means ownership. Your contributions are always 100% vested. That's your money. But the employer contributions could go through a vesting schedule, depending upon your employer. It could be immediately vested, 100%. It could go through a 5-year graded vesting schedule, or it could have some type of cliff vesting schedule. So best to check with your employer on the vesting schedule. Now, your contributions, again, this is a voluntary plan. It's flexible. So you need to make a decision. How much do you want to contribute from your gross paycheck? And you can express this either in the form of a percentage or a fixed dollar amount. We always recommend a percentage. Therefore, if you receive increases in your pay, you'll automatically end up contributing more to the 403B, the UMPIP. You also need to decide how to contribute. And that's important because how it comes out of your paycheck will determine how it's going to be treated later when you take it out, hopefully when you've reached retirement. You also have a decision to make. A high percentage of our participants are utilizing life stage investment management to kind of take that burden of self-managing and choosing your own investments off your shoulders. You can choose either one. Now, the most common personal contribution types that we see is on a before-tax basis and on a Roth basis. It's always a good idea, if you have a personal financial advisor, check with them. Many of you are eligible for EY, the financial planner line. Check with them. Roth might be a good idea for you to contribute, or it might not be such a good idea. So always check to see what's the best way to have these contributions taken out of your paycheck. The most common one, again, is your before-tax contributions. What you're doing here is reducing your taxable income. It's the first thing coming out of your paycheck is your before-tax contributions. You're saving money on federal and state income taxes. You don't have to pay taxes until you receive distributions later on in your retirement. So you could be enjoying many, many years of tax-deferred growth. Any earnings are not reported every year. So that is how before-tax contributions work. Roth contributions are kind of like the opposite. You're avoiding taxes later on, and that might depend on your personal financial circumstances. So good to check with EY or your personal financial planner. So you're paying taxes now, it's growing for you tax deferred year after year, and it has the potential to be tax-free income later on if it's a qualified distribution. In order for it to be qualified, the first contribution must be made 5 years prior to the withdrawal or the distribution, and you have to be at least 59 and a half. In the event that you become permanently disabled or deceased, it also would become qualified. So those are the contribution sources, and you can see, depending upon how it comes out of your paycheck, will determine how it's treated later on. Now, the contribution limits, they tend to change every year, and for 2024, they're very high. Okay, and I don't want anyone to be discouraged by these high amounts. Put in what you reasonably can afford. The maximum that you can do on a before tax and Roth combined for 2024 is $23,000. In addition, if you are or will be over the age of 50 in calendar year 2024 and you've maxed out on those regular contributions, you can set aside up to an additional $7,500 in what's called catch-up contributions. So for some participants, a total of $30,500. The total between anything that your employer is providing, that match or non-match or discretionary or conditional contribution, and your contributions can't exceed $69,000. The third way to get money into this plan is through a rollover. And a rollover really speaks to the portability of these 403B and 401K plans. And we're going to turn it over to Cheryl Hatcher. And Cheryl has an additional important role at Wespath. She also serves as our rollover specialist, which is an important role that she plays in assisting our participants. Cheryl, can you tell us a little bit about rollover contributions?
Yes, I would love to. So with the many hats that I do wear, I actually really like this one. I like to consider myself the rollover queen. So I'm going to tell you a little bit more about the rollover process. So from this slide, you can see that there are two different types of rollovers. There's a direct rollover and an indirect rollover. 99% of the rollovers that are received are direct rollover. What that means is that the money that you have from a portable 401k or maybe another 403b plan, or even a traditional IRA, those amounts come directly over to Wespath, or they might come directly to you, and then you just forward it right over to us here at Wespath. That's the traditional type of how a rollover is. An indirect rollover is where you actually receive the distribution, taxes are taken out of it, and then that can actually be rolled over into your account. You can actually add more that tax that was taken out back into it. But again, if you have questions regarding your rollovers, I definitely encourage you to contact me. Now, before I go on to the next slide, I actually want to talk to you about the actual rollover process. Okay. I know a lot of people actually do have questions regarding it, so I want to just tell you a little bit more about it. When you actually come to us at Wespath and you request and moving that money over, request a rollover, what I do is I send out a form to you, and the form just fills, you have to fill it out. It has your name, address, and you want to put information on there as far as who the rollover is with. So the financial institution that will be moving the money over from them over to us. Okay. Then once you have that form, and if you want, you can fill out that form. You can actually include a copy of the statement that you have from your financial institution. Forward that to us here at Wespath. And then what I do is when I receive that information, I send out what's called a letter of acceptance. Now that letter of acceptance includes your information, includes the copy of the rollover form that you completed, as well as the statements if any of them were sent in. And that letter includes all of the information regarding the rollover, what type of plan that we have, what type of funds that we actually can accept, all the information that your financial institution will need in order to roll that money over to Wespath. Then once I send that letter off to them, I usually wait about 5 weeks or so, and hopefully we've received the check by then. But if we haven't, then what I do is I follow up with you, and then you and I will call the financial institution together. I will check in with you to see if you happen to have the information, of course, but if you haven't, then we'll do what's called a conference call with them. And sometimes what's needed is just maybe some additional information, or maybe they didn't receive it initially, and then we get, I will fax the information over to them. But mainly, I just want to make sure that you're aware that you have someone here who will walk you through this process. It's not hard, but sometimes they can make it hard. And I want to make sure that you know you have someone here in your corner who can help with this. Okay? So that is the rollover process.
Thanks, Cheryl. Really interesting to hear how the process works, and no surprise that sometimes financial institutions, as you mentioned, are reluctant to give up that money. So it's
sometimes it is.
Good to know they have the Queen to help kick in the door. A
Definitely.
couple of live questions just came in. One is not a question, but Cheryl, you actually helped me with the rollover, and I want to thank you.
Oh, well, thank you so much. That's so nice. That's why we're here. That's why we do what we do, and that's what I love to do.
All right, this one came in. My previous employer sponsored not a 403B, but a traditional 401k plan. Is that usually eligible for rollover treatment?
Great question. And yes, a 401k definitely is eligible to be moved over into the UMPIP plan. So if you have any questions regarding what type of plans may or may not be available, then you just definitely let me know.
And just one more, Cheryl. What do you see most often? You talked about direct and indirect rollover. Which one do you see? What's the most common way to do this, the best way to do this?
I really, the main ones that I do see are the direct rollovers. So again, for the direct rollovers, the money will either go directly to us here at Wespath, Or it may come directly to you as the participant because the financial institution has your address. So they'll send the check to you. It will be made out to Wespath with a line underneath it saying FBO and then your name. FBO stands for benefit of. And so when you receive that check, you just don't have to do anything to it, don't have to sign it, just put in another envelope, direct it over to Wespath, and we will get it into your account.
All right, next right up, Cheryl's going to continue with the power of this concept called dollar cost averaging, which occurs naturally in 403B plans, defined contribution plans.
That is correct. Thank you very much, Bob. I appreciate that. So regarding the dollar cost averaging, that actually involves investing the same amount of money in a target security at regular intervals over a certain period of time, regardless of the price. By using dollar cost averaging, investors may lower their average cost per share and reduce the impact of volatility on their portfolio. So in effect, this strategy eliminates the effort required to attempt to time the market to buy at the best prices. So a lot of words. Now I'm going to try to put it into this illustration that you're seeing right now. On the left-hand side are the share price, and along the bottom is just the months of the year, as you can see. What this example is showing is it's assuming a constant monthly investment of $500. The gold line is the shares purchased, so how many shares can we actually purchase with that money, that constant investment of $500 each month. And the blue line is showing the share price. So as you can see, it definitely goes up and down during the course of the year, but we're still putting in that same $500 each month. So let's look at February. So February, the price had gone down a little bit, so that means we're able to purchase more shares for that month. So we were able to purchase 24 in this example. Now as that continues to go down, the shares purchased was going down, but the share price was going up. So we're only able to purchase 16 shares in April because the price had gone up. But as you continue to put in that $500 investment, hey, the share price went down in August, so we're actually able to purchase more shares in August because of that price being lower. So you can kind of think when the price goes down, you kind of think of it like it being on sale, so you can actually purchase more. So that's a wonderful thing of this dollar cost averaging. Now, regarding the next slide I want to show you and talk to you about is accounts growing over time. So here's another example of showing how the dollar cost averaging can actually help your accounts over time. So again, on the left-hand side of the graph are dollar amounts, and at the bottom of the graph are the individual ages. We are actually doing certain assumptions with this. With this example, that we are assuming an annual planned compensation growth of 3% and an annual investment growth of 7%. So in this first example, there's a participant at the age of 25 with a planned compensation of $35,000. If that person contributes 1%, it's actually going to increase to about $110,000 or $102,000 over the next 4 years. So again, a really nice increase. Increasing the amount to 4% actually shows how much more of an impact this increased amount has on your retirement. So going all the way up to about $400,000 and almost $410,000. But again, what I want you to take away from this is that this chart is not meant to discourage you whatsoever. If you haven't started putting money in, it's never too late to start. So in this next example, a participant who is 45 and earning $65,000 starts contributing 6% to their retirement plan. But so even after 20 years, the account has grown to over $200,000. So now I'd like to talk a little bit more about the legislation pertaining to the retirement plans that was approved at General Conference. What I want to emphasize is that you are not losing any of your balances whatsoever. If you happen to have a pre-82 or the MPP plan or the CRSP plan, you're not losing any of that money, okay? But what I do want to talk about is the new plan that is actually going to be coming up as of 1/1/26, and that's called Compass. But before we go into that, I want to let you know that as of December 31st of 2025, it was approved at General Conference that the CRSP plan is going to close. Now, as you have right now, you have the defined benefit, which is, again, a formula benefit. And then you also have your defined contribution, and that's the account balance, and that is going to stay. Regarding the CRSP defined benefit, prior to 1/1 of 26, you're still going to calculate the benefits based on that formula consisting of the denominational average compensation, the factor of 1.25% or 1%, and your years of credited service. After 1/1 of 26, that CRSP plan is going to be closed, but the way you will calculate benefits when you actually do take benefits, once you commence those benefits, that denominational average compensation, it's going to be increasing by 2% each year. So it's going to be a constant 2% added each year. And also the other factors are going to remain the same as far as the credited service, and but the years of credited service is actually going to still stay as a fixed amount. That your factor is going to stay the same, but the length of time that credit service is now going to be in a closed period since this particular plan has closed. For the defined contribution part, prior to 1/1 of 2026, the matching and non-matching contributions that Bob had talked about, it is still going to be continuing. You also have that life stage investment management, which I'll talk about a little bit later, and you also have life stage investment management, or you can actually self-manage those investments yourself. The retirements during this time before 1/1 of 26 will have the same distribution options that we currently have in place. Now, after 1/1 of 26, again, those options are flexible in retirement when the benefits are commenced. Still have all of those options that are available to you, and just want to make you sure that you're aware of all of this information. Now, regarding Compass. Compass is going to be a new plan starting 1/1 of 26. And there's going to be, this is actually for clergy members only. All right. And this plan consists of 3 parts. Now, the first part is what's called a flat dollar contribution that is paid to each clergy person. This helps the lower paid clergy receive an amount that is equal to all clergy. In 2026, the amount will be $150 per month, payable by the plan sponsor or employer. This amount will increase 2% per year in $5 increments. So the second part of the Compass plan is a contribution of 3% of pensionable pay. What is pensionable pay? That is, it is your base salary plus housing allowance or deemed value of a parsonage. So as Bob had talked about before, this is what we would consider a non-matching type of contribution. It is worth noting that in the CRSP, the housing allowance is based on 25% of base pay, but with Compass, this actually increases to 35% of base pay. The third part of the Compass plan is a dollar-for-dollar match on up to 4% of your pensionable pay. If you contribute 1%, your plan sponsor or employer will actually contribute 1%. If you contribute 4%, then your employer or plan sponsor will actually contribute 4%. So think about if you actually contribute 4%, then the matching contribution would be 4%, which would be a total of 8. Adding to it the amount that will be put into your account because you are a clergy person, that's 3%. So 3 plus 8 is 11%. You could actually have up to 11% put into your retirement plan, plus that $150 per month. So a 4% contribution by you can actually give you an 11% contribution to your retirement plan. If you can, we understand you may not be able to put that 4% in right away, but try to work up to that amount to get the most out of this plan. Also want to make sure that you're aware that there will also be a match if you are paying student loans. Wespath is currently working on the administrative components to this, so more information will be coming out regarding it. Now, the next part is regarding the RPGA. And the RPGA is, who is this for? This is actually for clergy or lay employees of the United Methodist general agencies like GCFS. That's who this is for. What does it mean? It's actually, what's going to happen is that RPGA, again, the petition that General Conference agreed to actually close out the RPGA and automatically transfer that money over into their UMPIP account. When is it going to happen? We're going to, it is being worked on, and as soon as it's administratively possible, it will be done. So we will definitely keep you posted on all of this, and all of this other information that we've been talking about, we'll definitely keep you posted on all of this as it comes up as well. Now, investing in your account. We want to make sure that you're aware of all the benefits of investing with Wespath. Sustainable investing, again, upholding the values of the United Methodist Church. Again, we're wanting to make sure that money is there for you in retirement. You've got many different options that are available to you. We want to make sure that you have, getting the most out of these plans. Low expense ratios, no commissions, and again, I'll be talking about the life stage investment management that can actually help you and not have to self-manage those funds yourself. So that's other options that are available to you when you actually invest with Wespath. Now, talking about investing with Wespath, I'm going to go from left to right. You have the choice of actually choosing your own investment funds. That's always your call. You can do that. There's different ones available to you, and you pick which ones you would like. You can also contact EY Financial Planning Services. They can actually walk through an asset allocation with you during their consultation you can have with them. And I'll go through some additional information regarding EY later on in this webinar. But again, Life Stage Investment Management is a wonderful tool that we actually have here. It's of no cost to you, and it's taking that guessing game out of the investment process for you. So let's talk a little bit more about Life Stage Investment Management. So what is it? So it's actually a personalized management tool for all of your defined contribution accounts. So defined contribution, again, are the ones that you can actually see in your statements, and you have the flexibility with those. We tend to say that it can actually set your accounts on autopilot, but that doesn't mean that we're actually not doing anything. A lot of things are being done behind the scenes for that. Every year, or once a quarter, based on your birthday, we actually do look at your investment mix, and sometimes they can actually drift out of what we deem, or what Life Stage Investment Management deems you to be is your ideal profile. So what they do is they can actually go back in and actually make those account allocations to where they need to be. Now, those allocations are tailored to each individual person. You're different from me, we're different from Bob. Everybody can have their own elections. That's why it makes it so unique and individual to you. So again, those different allocations, those variables that are affected are, let's say, your age, when you're actually thinking of retiring, your risk tolerance, and of course, if you're going to be getting Social Security. Now, regarding that investment profile, if you don't actually have one on file, then what we will do is we will put you in what's called a default. The default would actually be where you have a moderate risk tolerance, where you actually commence benefits at age 65, and that you're eligible for Social Security. Now, maybe those aren't the ideal ones for you. Maybe you're more conservative, or maybe you're an aggressive investor, or maybe, as Bob had mentioned, maybe your full retirement age is 67 and you actually want to have your benefits commence at that time instead of 65. So a lot of different things go into these allocations and these variables. So again, you can actually set up your own personal investment profile on Benefits Access, and where LifeStage will actually target your allocation according to that profile. So again, as I mentioned about Life Stage Investment Management, again, it creates that portfolio that's customized for you. It sets that asset allocation, and we do review this quarterly based on your birthday. And again, it will rebalance those funds if they wind up getting a little bit out, let's say, out of the profile that has been set up for you. And this can actually be done, you can actually utilize Life Stage Investment Management in active service and also in retirement. So it's a wonderful thing to actually think about being in. And it's not something that you have to pay for. If you want to be in life stage, but then you want to self-manage later on down the line, you can do that. And you can come back in at any time. All right, so now I'd like to turn this over to Bob to go talking about our accessing your account.
Thanks, Cheryl, for that
You're
explanation. Just one additional rollover question came in,
Yes.
and it just has to do with expenses or fees. The
me
person
put
is
that-
asking, are there any costs associated with the working with a rollover specialist at Wespath?
Oh, great question. And no, there is not. So any time that you need help with a rollover, feel free to contact me. So you can contact me through the customer service team, or after this, I'm sure some of you already have my contact information already, but I can give that to you, and then I can help you through that process.
All right. And then one question came up about investing with Wespath Benefits and Investments. You had talked about choosing your own mix of investment funds, and the participant is just asking, well, how do you go about that? So I'll just answer that. You
Great.
can go into Benefit Access, you can switch off Life Stage, but before you do that, maybe make a call to EY. Make sure you have a good understanding of our investment fund lineup. We have everything from safety, capital preservation, to fixed income bond funds, to growth or equity funds. So in order to self-manage, you should have a good, firm understanding of those investment funds, and then match it up with your own financial goals. What are you trying to accomplish with this money? And you can simply begin to self-manage. Always a good idea to check with EY.
Yes.
Now, the topic of accessing your account. We do realize here at Wespath that life happens along the way, and it's not always predictable what's going to occur before you reach your retirement milestone. So the first thing I would mention, if you need access to your account prior to retirement, make a couple of phone calls. Call EY, the financial planner line. Discuss any alternatives. This is something that you want to avoid if that can be avoided. You can also call Wespath and discuss different ways to get out money. Okay, there are hardship loans. There are some conditions for that. There are hardship withdrawals available. Cheryl had talked about rollovers. That account is always eligible to be taken out as well before retirement. You can withdraw that. Once you reach this magic age of 59 and a half, you can do what's called an in-service withdrawal. You're taking out your money, okay? What happens at 59 and a half is the 10% penalty for that premature distribution goes away. In the event of a disability, there will likely be immediate and longer term, perhaps, financial needs. You'll have access to your UMPIP. Certain qualified military service withdrawals are available. And then ultimately, upon any separation of service, be it retirement, you change jobs, you quit, whatever, you would have access to your account. This is your money. Keep in mind the employer contributions that we talked about are subject to that vesting schedule. So you always want to be aware of what that vesting schedule is. When you do reach retirement, what's nice to say is that you do have flexibility. Depending upon when you retire, you might have a lot of flexibility. No two retirements are exactly the same. You could reach retirement and you need to have access to this money right away. Other folks, we talked about those different sources of retirement income, might not need this money right away. So what are the options? You could take a full lump sum distribution to clear out your entire balance. That might not be a great idea from a financial, a tax, and a retirement planning perspective, but it is an option. I've seen participants take out partial lump sum distributions to help catch up with their financial needs. These plans are really designed to provide you with income on a monthly basis, and I like that plan design. Similar to Social Security, a monthly direct deposit, a monthly source of income, replacing the paycheck that has gone away. How do you do cash installments? Well, two different ways. You can self-manage it, and that means simply that you tell Wespath how much of your money you want us to send to you on a monthly basis, so that helps replace that paycheck that has gone away. And then we do have a robust life stage retirement income. There's a handout describing life stage in great detail on the toolkit. Life stage retirement income, and we've added some optional customizable features. I had mentioned earlier that there's a feature where you can let life stage know that you're going to delay Social Security, take advantage of those delayed retirement credits, and build a bridge to that milestone when you do collect Social Security. You don't need to do anything. And your money, your balances across the investment lineup don't become frozen. They're not sitting idle. Your money is still invested for you and hopefully still earning and growing for you on a tax-deferred basis or a Roth basis. You can leave it on account until you are required by the government to take out distributions. Those are called RMDs. Okay, and they've raised the ages of the RMD requirements. For many, many years it was 70 and a half. That got raised to 72. And now for many people on this webinar, it won't be until 73, or for still more, it won't be till age 75. You know, easy for me to say, you might be well into it, having a need for that income well before that. Always a good reminder is on benefit access. Verify that you do have designations of beneficiaries listed. Okay, typically you'll see the spouse as primary or sole beneficiary, but you also want to list contingent or secondary beneficiaries in the unfortunate event if something happened to you and your spouse at the same time. So you always want to keep that current. I'm going to turn it back over to Cheryl. I'm going to continue to monitor the question box, and she's going to talk about some of these really important resources that are available for our participants on this journey toward that retirement.
All right, thanks, Bob. Yes, resources. We have so many of them. A word we like to throw around a lot is we have a plethora of resources that are available. So the best place to go to is wespath.org. A wonderful source of information. You can actually look at all of those funds that we have, see how they compare, see what the fees are, the daily value. All that information is out there. But one of the best things that I like to go out to wespath.org for is that's where I go to benefits access. That's where you can actually see your current account information, all the tools that are available to you, your balances, you can change your beneficiaries there. As Bob had just mentioned, you want to make sure that those are updated appropriately. On every screen that's out there, there's questions. So it's a wonderful educational resource that's out there. So if you haven't done it already, we highly encourage you to go out and register for benefits access. And it's there. You can see all of your information out there. Now, we've alluded to EY Financial Planning Services in the past. They are a wonderful partner of ours. They've been with us for over 17 years now. A wonderful business financial partner with us. They are here to give you confidential, professional, one-on-one guidance. They are not there to sell you anything, but they have wonderful articles and resources available there on their site. You can actually go there through the wespath.eynavigate.com, or you can call the number that's on the screen. Wonderful resource. Most people are actually available for it. But what kind of questions can they answer? Well, here's some some topics that they can actually review, as well as many others. So again, coming up with that retirement plan. Bob had mentioned about whether or not before tax or Roth of type of contributions might be your choices. Is Roth a contender for you? That would be a good question for them. Talk about all the different retirement plans. They are very familiar with all of our plans, and they can help you understand them and see what would be best for you and your family. They want to talk about your whole entire household, so we want to know all that information that you have. We've actually had a couple of our educators call them up and say, hey, should I buy or lease a car? They were able to help them through that. So no question is too big or too small for them, so we do encourage you to utilize them. Now, is there a cost? There is not a direct cost to you. EY does charge us for their services, but the money that we pay them comes out of our operating expenses. So we want to say it's technically free to you because you're not having to pay anything. And again, they're not selling you anything. They have nothing to sell. They're just there, like we are, to want to be able to give you the best information possible for your retirement, for your entire household, for your family. Another resource that we have is the one-on-one consultations with all of our benefit educators. So we can actually help you with maybe coming up with some of those questions before you contacting EY Financial Planning Service as well. We can help with those types of questions. We can help you understand all of these plans that we've been talking about today. We can go through a retirement projection, think about, how much money you'll have, in the future. And you can actually go out there and schedule your appointment at the site that we have there. This will actually be included with our follow-up email with recording link as well. But one of the benefit educators is Todd Crevice, and he's actually there in that laptop. So he might be one of the ones that you will actually have. Or it could be Bob or I or Frank, who's on monitoring questions as well. Now, as far as the action planning steps, the next steps, there wouldn't be a Wespath webinar without some action planning. So I'm going to start it off by saying, hey, let's talk about enrolling in UMPIP if you haven't already. Wonderful plan. I hope we gave you enough good information about it that you want to be in it and you want to maybe put more in, right? So, Bob, you want to talk about the next ones?
Number two, elect a contribution amount. If you are initially enrolling in UMPIP, give it a thought about how much and how do you want it to come out of your paycheck. Again, it's flexible. You can make changes at any time. Put in an amount that you reasonably can afford. And if you've been a long-term participant in UMPIP, when is the last time that you took a look at that? How much is coming out of your paycheck, and how it's good to review that and maybe increase it if you've received increases in compensation.
Mm-hmm. All great information, Bob. And what I want to do is tell you, hey, let's talk about determining your investment strategy. Again, how do you want to do that? Do you want to do life stage investment management? Do you want to self-manage? How do you want those risk strategy to be? Do you want to be aggressive, moderate, or conservative? All of those different things that you want to think about for that investment strategy.
And number four, if you haven't already, register your account at benefitaccess.org. We've made several updates to our website over the year. It is safe, easy, and secure, and quick to register if you haven't already. That's benefitaccess.org. You can view your transaction history, see how your accounts have grown, take a look at your statements, update beneficiary designations, lots of information on your benefitaccess.org account.
Right. Always a great thing. And then also, I want to talk to you again about EY Financial Planning Services. We've given you a lot of great information as far as what they can do and what they can help you with. Contact them. Even though it might be a little disconcerting to call them and go through your entire financial history, that's what they're there for. They have no judgment. They just want to be able to help you and give you all that information that they can to make sure that you have the best retirement possible.
And number six, schedule these one-on-one benefit education consultation. We have had this program in place since 2020, so it's on its fourth year now. And it's one of the things that we truly, as benefit education, our team really loves to do these benefit education consultations. We like to see you. These are safe and secure. We will verify who you are, make sure we're talking to the right person. We'll send you a code that goes to your cell phone or a mobile device. So schedule those. There's no cost, and they are confidential 30-minute sessions. We have slots right now through the end of June. We'll be adding July in about another 2 weeks or so. So we look forward. You could express on the registration too what your particular areas of interest are. We'll take a look at your benefit access account. We'll be prepared for those consultations. We look forward to seeing you on that. So Cheryl, that concludes our website for today.
It does. So thank you so very much. We definitely appreciate you being here, spending time with us while we were giving you all this information. And Bob, it's great doing this with you.
Yes, it has been. On the behalf of the benefit education team, we continue living into our mission of caring for those who serve. So that's myself, Cheryl, and Frank and Todd on this quarterly segment. They're working behind the scenes. But thank you for joining us today.
Thank you.